Today, we're cracking open what looks less like a poultry business and more like a financial fortress. We're doing a deep dive into the numbers behind Ceylon Grain Elevators, and trust me, what we found inside is pretty remarkable. And just a quick heads up before we get started, this is a fundamental analysis for educational purposes only, so please don't take it as financial advice. Okay, let's get into it.
10.5 billion rupees. That's the amount of cash and short-term deposits Ceylon Grain Elevators has just sitting on its balance sheet. You know, in an environment where most companies are struggling with debt, this one is practically swimming in cash. So let's pop the hood and see the engine that's making all this happen.
So let's kick things off with part one, the profitability engine. To put it simply, how good is this company at actually making money?
First up, the top line. Revenue hit nearly 22 billion rupees, which is a really solid 30% jump year over year. Now, a big part of this is the overall economy. Tourism's bouncing back, and that means demand for things like processed chicken is surging. But that's only half the story.
Now, here is where it gets really interesting. Their profits, they actually grew faster than their revenue. Sales were up 30%, sure, but profit absolutely shot up by 44% to 2.4 billion rupees. That's not just growth, that is incredibly efficient growth.
This right here is a textbook example of operating leverage. Think about it. Even as their material costs were going up, their gross margins actually expanded. And that proves one critical thing. The company has some serious pricing power. They could raise prices to cover their costs, and their customers paid it.
But when we dig a little deeper, we see a strategic shift in where these profits are coming from. The real growth engine right now is the milling and farming segment. Its operating profit literally doubled. Meanwhile, the poultry breeding segment, which, don't get me wrong, still has massive 40% margins, saw its total profit drop. So the company is rebalancing its weight, and right now, milling is clearly carrying the load.
All of this profitability is what builds our second part, the financial fortress. And this is where the story goes from good to, well, truly exceptional.
In a high-interest environment like this one, debt can kill even healthy companies, while Ceylon Grain Elevators has virtually zero solvency risk. Their interest coverage ratio is a staggering 34.3 times. To put that in perspective, their finance costs are less than 0.5% of their total revenue. They are barely breaking a sweat.
Now look at this. The industry standard for a safe company's current ratio is about 2. Ceylon Grain Elevators is sitting at 4.39. This chart really says it all. They have more than 4 rupees in short-term assets for every 1 rupee they owe in the short term. That is an incredible buffer.
And just to really drive the point home, look at this breakdown. That 10.5 billion rupee number we started with, that represents 45% of the company's total assets. Almost half of everything they own is in cash or easily accessible deposits. That's the definition of a fortress. We also spotted something else on the balance sheet, a massive 1.48 billion rupee surge in inventory. Now, you might wonder if this is just unsold product piling up. But given the timing, it looks like a calculated, strategic move. They're stockpiling raw materials ahead of the busy Q4 festive season. They are loading up for the holiday demand surge.
Which brings us to part 3, and this is where things get a little weird. We're calling it the cash flow puzzle, because on the surface, there's a number here that looks like a major red flag.
And here is the puzzle piece that doesn't seem to fit. The company reported a net profit of 2.8 billion rupees, but its cash flow from operations was only 168 million. That's a cash conversion rate of just 6%. In almost any other situation, a number like this would set off major alarm bells about the quality of those profits.
So that's the central question, right? If profits were so high, where did all the cash actually go? It didn't just disappear.
And here's the solution. The cash was spent on 2 very deliberate things. First, they used over 2 billion rupees to pay down related party debt. That's money owed to other companies within their own corporate group. So they were basically just cleaning up their internal books. Second, they made that 1.48 billion rupee investment in inventory for the holiday season we just talked about.
So once you account for those 2 big strategic decisions, the company's effective cash generation was actually around 2.2 billion rupees, and that translates to a very healthy 79% cash conversion ratio. So you see, this wasn't a cash flow problem at all. It was a story of disciplined capital allocation.
Which brings us to our final verdict. What does this all mean when you put all the pieces together?
1. The profit and loss statement shows powerful operating leverage and real pricing power. 2.
The balance sheet is an absolute fortress with virtually zero debt pressure. And 3, the cash flow statement, which at first looked weak, is actually telling a story of disciplined deleveraging and smart strategic investment.
So, we'll leave you with this final thought. When is a red flag not a red flag? The answer is when you look beyond a single number and understand the complete story the financial statements are telling together. In analysis, context is everything.